So you're bringing the register, but you still have large positions in Apple and Microsoft. Give us some context on what you're doing.
Yeah, I think you've talked so much today correctly about valuations. And at some point, you have to look at these things and say it's not the worst thing in the world to take a little bit of a profit. And as portfolio managers, we do this to right-size positions, to rebalance, looking at everything from a risk management perspective. Too much of a good thing can sometimes be problematic. So we own Apple, Scott, and we own Microsoft. Both of these names have been, let's face it, doing pretty well this year. And what we've been doing is just trimming into strength week after week. We're maintaining a 5% position in each of them, but we don't want to be overweight them in either one name.
But if you're keeping that size position, that says to me you're not overly concerned about valuation, or you'd be keeping a much less position than 5%, wouldn't you?
Well, I'm no market timer, Scott. So I think a 5% position, having a 10% weighting in tech, has a good risk budget for us. Quite frankly, it would have been awesome if we were all tech this year. Imagine the celebration. But we allocate across all sectors. So from my perspective, I want to have an exposure to it, but I don't want to be overexposed to it.
You think Apple's too expensive at 30 times?
Oh, I do. Yeah, absolutely.
You do?
Yeah, I'm not going to sell the stock because momentum can move things. Markets can move stocks even higher when you get that kind of trade. But from a valuation standpoint, I think it's a little ahead of its skis.
Are you thinking of valuation differently than you otherwise would because of the unknowns of AI? And I mean that in a positive sense to what that ultimately could mean for earnings of these stocks?
Yeah, that's a great point, because you were talking earlier about comparisons to 1999, and that's the difference. These companies have earnings. There's another untapped revenue stream that can come into it. When we were talking about stocks in 1999, forget revenues, forget earnings, that was a hype train. So I think you can. And I think people always pay up for growth. I'm not sure what that valuation should be, but I have the confidence to keep an allocation to both names.
You have a new position in Starbucks. Why?
Yeah, Starbucks is a name that we rotated into. So we're taking some profits from the big winners, and we're looking for things that have underperformed. We haven't owned Starbucks in years, but it's off 15% since earnings. It pays over a 2% dividend. They've had pretty strong dividend growth over the past 3 years. And for me, the multiple's a little bit strong, but relative to Starbucks over time, it doesn't seem that overpriced.
How are you judging what is an obviously critical growth area for that company, being China, which has been a disappointment? Well, and that's one of the reasons, I'm sure, why the stock is where it is.
Well, I've never put too much value on what China says they're going to do or not do, so I'm kind of discounting that from our equation. If the China reopening story does happen, well, that'd be great for us because it'll put the stock at a higher price than we're pricing.
Yeah, but how can you discount that part of the story if it's such a significant part of the overall story?
Yeah, well, I think that's why the stock's down 15%.
Is because the reopen hasn't been as robust.
Yeah, it hasn't played out.
No, that's my point.
Yeah.
Is that if that becomes the base case at this point, that it's much further pushed out than we thought.
Yeah, well, that stock could go lower. Yeah, and what I did is I took an initial position. We have a 15% pullback on the stock. We took profits on things that are up 40, and we took a small position. I'm not convinced that China's going to reopen. If that stock trades lower, we'll add into it.
Oh, I got you. Okay, so FedEx reports in overtime in just a little bit. You added to UPS. Why do you choose UPS over FedEx?
Well, I think FedEx is in a much better place than I have historically, but I still think from a logistics company, UPS is head and shoulders above what FedEx is trying to do. I give them tremendous accolades for the initiatives that they're doing, but UPS is just so far ahead. Now, they've got problems, Scott. That stock is down 10% since earnings, and they've got to fight against the union in terms of what that's going to look like. And I'm expecting that could look like another $1 billion to keep labor satisfied correctly, properly, and keep them in the game.
Super quick. General Mills, right? You wrote a covered call on GIS?
It's hard to write covered calls when there's no volatility on a consumer staple, but we were able to write a call for 55 cents, 5% out of the money. Doesn't sound like much, but it translates to a 7% annualized return. When you add that to the dividend, you're getting almost a 10% yield on a cereal company.